Hi, this is Randy Finney with the Right Side of the Chart, and this is an early session market update for Thursday, August 8th, 2019. Figured this is probably about as good a time as any is to get one out. Let's talk about those potential bear flags, and as I in the post that I made yesterday, I emphasized the word potential. I'll show you why I say that. Bear flag. First of all, what makes up a bear flag is three components. You have an impulsive move down. They refer to that as the flagpole. Then you have flagging action. It can either take the form of a bull flag or a pennant. Sometimes you get a pennant shaped pattern, and they call that a bearish pennant. And then you have an impulsive breakdown with a move that's typically equally as impulsive on the way down, and the measured target is the distance of the flagpole, that move leading up to the flag, added to the highest point of the flag. That would be your measured target. So why I call it potential? Like any pattern, any chart pattern, whether you're looking at let's say a head and shoulders topping pattern, or a wedge pattern, any pattern is only a potential pattern. It's not a buy signal or a sell signal. It is merely a pattern waiting for an objective entry. And so with any chart pattern, no entry, no trade. And so let me show you an example here, and I'll just eyeball this chart. I'm sure I can find a bunch. Okay, so here's an impulsive move down right there, and looks like we were flagging at that point, but guess what happened? We just kept going up. There was no sell signal given, no move down on the flag. Another impulsive move down, so potential flag there again. So I think you get the point now. That's what I mean by potential. And even another one there, that's more of a bearish pennant. A little impulsive move down, but no sell signal triggered. So that's what we have in the markets, and they're starting to stretch the the ideal the ideal symmetry of those patterns. You want the flag relatively small to the flagpole, and you want it to take that shape. Right now we're going to we're moving up for close to a back test of those gaps that I talked about. So we'll continue to monitor it. This one, for example, got a little bit long in the tooth. That flag there is a little long in relation to the flagpole, yet the essence of the pattern, meaning an impulsive move down followed by a period of upwards, consolidation with slightly upward prices, and then boom, an impulsive breakdown. You can see right there, big red candle that broke down below, and then you followed up with even more impulsive selling with a gap down the next day. So that's what I'm looking for here. And again, it either plays out or it doesn't, and it's yet to trigger an entry. Apple, like I said, similar thing right there. I mentioned those yesterday. Potential flag patterns there in Apple. So like I said, either QQQ and Apple, these both play out, or they don't. It's that simple. I wanted to share something before I get into the charts. We'll talk about the levels here. Well, there's Apple at resistance. I want to get to QQQ, but I want to share one thing that I talked about recently, my expectations as to why there's most likely more downside to come. This is an article in today's Wall Street Journal. As I was saying recently, the drops, such as the impulsive drop we saw last week, you very rarely see a drop that impulsive. I highlighted some a minute ago showing you the bear flag patterns, but the impulsive nature of the drop over the last week here. Let me show you the chart in case you've been on vacation or somewhere. This is the drop I'm talking about right here. This very impulsive drop shows well on the daily chart as well. That is the biggest drop that we've had since back here, consecutive selling. We had a little correction here and followed by a kickback rally. But so far, this is the first kickback rally. And like I said before, that is indicative of these type of patterns here. Let me turn off all the drawings here. Nothing falls forever. You get the impulsive selling, you get the kickback, and then another leg down. So rarely are you one and done after such an impulsive drop like that. Usually there's more to come, whether it's just one more wave down, one more leg down I should say, that would be in this case an A, B, C correction, or you have a additional waves coming to a drop like that. So what I wanted to show you was this article here from the Wall Street Journal today that kind of meshes with what I'm saying. And now This isn't subjective. This is statistics. This is somebody that did the homework, and pretty much you can see right there it says big drops of 3% or more, while relatively infrequent, tend to occur in clusters when they happen. And so they went on to cite some statistics here. If you're a journal subscriber, you can read it, or just pause the video and read it there. But point they're making here, in the last 5 years since 2010, when the stock market dropped 3% or more, there was only 1 year where that drop was the only one of its size for the year. And so that means, the odds are, again, 4 out of 5 times there were additional big drops of 3% or more, because again, those moves come in clusters. They're very rarely one-off instances. So therefore, that kind of jives with what I'm saying. It's just a matter of how far do we bounce and when's the next leg down start. And of course, as I always say in trading investing, nothing out there is 100% guaranteed. And so there you have, in this little small sampling of data, what was that, 4 out of 5 they said, so 80% chance, if you want to use that, there's more downside, and then a 20% chance that there's not, 1 out of 5. So you guys take your picks. I play statistics and probabilities, whether it's trading, investing, whether I'm playing poker, that's what it's all about, and just putting the odds in your favor. And then of course, if you're wrong, you don't get married to the trade, and that's the good thing about, and that's why I'm doing this video. Where might I be wrong? Well, as I've shared recently, pretty much if we go much past the my uppermost bounce target, which that's been this range, we're right in the middle now. I put a post out this morning. This certainly, we're getting up, and you want to try to get every last cent. I'm sure a lot of sellers will be looking at that bottom of the gap. Technically speaking, the gap is where we closed the previous day, up here, all the way up here. You gap down, there's the closing price, but this is a cluster of candles there, and so I have that range. In fact, the 186.06 is set a little bit shy. If you really capture all the bottom of those candles, which I'm doing right here, it really should, that number should come in the top of that bounce or resistance range. There it is, about 186.30 if you want to get really close. So that's it, and gaps are natural resistance levels, so we're getting there. We're right now, you can see the purple line here, that's the 38.2 Fibonacci retracement. That means from the move off the highs down to the lows, we're there. On SPY, we are right in smack in the middle of about a called a 290 to 291 resistance zone. Again, the gap's a little higher, but those are the candles that I'm looking at. That's where I like to set the resistance zone, and we're smack in the middle. So I can tell you two things. I can tell you one thing with certainty, and that is that I believe this is an objective level to short. There's two ways I short. I either short bounces back to resistance, or I short a break of support. So I can tell you I believe it's objective. The other thing I can tell you, and this one is not a guarantee, or I should say it's that there are no guarantees. I'm either going to be right or wrong. So don't confuse objective with high probability. I put a post out this morning with these levels, and I said I'm watching it. If my confidence was that high, and I may add this soon today, if we get a lot closer. The way you look at it, objective means, okay, you short here, I'll go right to where we are, 290.60. Let's say you're a SPY trader. So you short at 290.60. Again, my preference scale in, that allows for about another 1.2% upside, we'll call it. And then I'll allow a little bit above that level. I will not continue to add to a short at that point. I will not continue to scale into. I'll scale up to 294, but not above. And then should we close much above that, I'd look for 60-minute candle closes, not a little brief spike above. 60-minute closes, especially daily closes. And then at that point, so whereas this was my scale-in zone from the bottom of the gap up to here, short, 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 I will then scale out. I'll have staggered stops. Some people will do all or none stops, and sometimes I will, but I would do this, because if we continue to push through there, the more we push, the higher the chances that that'll prove to be a that this was just a one-off kind of a rare one-off event to see such an impulsive drop. There's still that downtrend line. I pointed this downtrend line out before when everything was back testing the wedges. So that would be, that's where really if we get above there, then that's all over. I think that would be a breakout. So this is, although this is really is again, I said my preferred bounce target right here, max bounce target. This is where the technicals really change. This whole area could just be a big fake out and get above there, or a very big counter trend bounce. And I can tell you, this is a level where I would be out of shorts. Can't tell you right now if I'd be going long at that point, because I'd have to see how the charts look from when they got there. So that's kind of my plan on QQQ. Really same story on QQQ. Posted this morning about 185 to 186. Again, that line could be a little bit higher if you want to really zero in, look at the bottom of the candles. I put the crosshairs there, about 186.30. And the downtrend line isn't as clear on QQQ. I'd probably look something like, I would look at this downtrend line as well as that one on SPY. But there it is. So that's where my uppermost scale in preferred, what I call my preferred bounce target zone, is up to about 188.37 right there, give or take. And just a quick update on the related assets. Now, Treasury bonds and stock market are two completely separate asset classes, but there's a relation, and the relationship is this, that Treasuries, we've seen, especially this big ramp that we had recently, was due to the fears in the stock market. Treasuries are the king of flight to safety assets, with gold being number two, I would say. But bar none, Treasuries, that's where institutions and individuals will flock, especially the smart money, the big money, hedge funds, pension plans, things like that. And so far we've seen a pretty big reversal because the stock market's rallying. Stock market hits support, so what you're seeing is a reversal. We go from risk off, where risk off is when the stock market's dropping and people are buying treasuries, to back to a risk on market. So the treasuries are pulling back now, and there it's a uptrend line on the 60-minute chart at TLT, and you can see some gaps and some targets down below. So what's going to happen here is, and this really kind of dovetails with my analysis on the market. There's ZB. If you like to trade futures, you can see divergence on the 60-minute chart at the high. We broke the trend line and this secondary trend line here. This was the first one we broke and back tested and moving lower. So if the stock market continues to rally, if we don't see that another leg down soon, you're going to see treasuries most likely continue to fall as that flight to safety bid is unwound and money moves back out of treasuries into stocks. Normally I might short this again, and that's why I wanted to cover this, TLT or TBT. The reason I'm not is because, as I showed you earlier, there's still odds favor another leg down in the stock market, and if that happens, then treasuries will once again either catch a flight to safety bid, or at the very least, there are times I've seen the stock market and treasuries both falling, but it would certainly face a headwind. It's not going to help a TLT or TBT trade, shorting treasuries. It's not going to help if the stock market goes down, especially another impulsive leg down. So I wanted to share this, and if the odds and statistics and the technicals on the charts don't play out, and meaning we don't get another leg down in equities, the market goes on to rally to new highs, you can expect a much bigger drop in treasury bonds. So they're kind of, those trades are contingent. Same thing holds true with gold. GLD, a flight to safety instrument. Longer term intermediate charts are still bullish, but near term, what's happened is the stock market's rallying now for another day this week off those support levels, and gold is broken down below this uptrend line on the 60-minute chart here. You can see, had a little price channel. If I drew a line on the top, this price channel right here. So there's a breakdown in gold as well. And same story. You're probably going to see a deflation of that. This was a risk off trade right here. Gold's been in an uptrend, but it just, that sell off in the market, people are flocking to gold. Now the market's going up, so you're seeing some profit taking there. Again, define your time frame, your time horizon, and I would say this: if your convictions, you think the stock market's going to new highs, then you'll probably see more downside in gold. But if you think there's going to be another leg, then it's probably not prudent to short gold at this point. Just wanted to show you the charts. If we do continue to fall, if the market rallies, or for whatever reason gold falls and the market falls, support down here. But the big level is gold had this recent sideways trading range or consolidation range right there, the top of which is most likely, or anywhere in between, gets really thick around here. A lot of trades occurred in that range, so you can look at these as potential pullback points if you're whether you want to short gold or whether you're bullish and you want to look for the next objective long entry into gold for the next leg up. Here's gold on the daily chart. And I'll tell you, when I look at gold and treasuries, they both look really poised for, decent pullbacks. Gold has this divergent high, and again, don't get me wrong, I'm still longer term bullish on gold. Intermediate, nothing's changed there in the longer term outlook, but just as I was bullish, and we had an official long here on gold at this, on that initial move up, but when I suspect a decent correction, that's when I want to sidestep, get out, lighten up on gold or my gold mining stocks, and that's what happened again. So the last time, here's a divergent high, negative divergence right there on the daily chart, and from that point gold corrected, and in fact it was the biggest correction in this uptrend since. We dropped from the highs down to the lows 6.5%, and it took almost 2 months to do it, if not more. Did I get the highs right there? Let me go to the lows. 2.4 months. And so once again we have a divergent high right now, negative divergence. It is not confirmed. PPO would have to turn down. By confirmed meaning we need a bearish crossover. Right now this PPO is a momentum indicator. It's pointed higher. It could continue higher, and then at some point, if we take out the previous highs from here and here, we no longer have divergence at that point. So but right now it is, again, this is all, that's why I'm doing this video, they're all intertwined. If this was a one and done event in the stock market, because now we know, the currency wars are heating up, the trade wars, the Fed's going to become more easy now, pump more juice into the market. So if they can gun the stock market up, this you have these two doji sticks up here. There's a potential for at least a tradable top in gold right now. So at the very least, is it objective to buy right now gold? Treasury bonds, no. Do you want to short them? It depends on your view on the market. I'd probably wait and see if the markets can power up on through those uppermost bounce targets, or of course you could take a shot at it. But again, I would hold off at this point in time on adding to any gold positions because of these technicals and because of the right now we don't have any signs of reversal in the stock market. I point out objective levels to add shorts, but then hey, if those prove to be wrong, don't be married to those trades. And if I get a better, a little better or stronger convictions on if and where and when this bounce may reverse, then I'll, as I said earlier today in the post on QQQ, I'll consider that as an official trade. But as of now, let's just watch and see how this thing materializes. Let's see if they can hold and build on to today's gains. The market continues to rally since I've started this video, so let's see how the day ends. Just like there's an old expression, it's always darkest just before dawn. That's how it looked in the stock market just last week. I'm sure a lot of people thought it was never going to stop falling when it hit here, and that's exactly when the stock market bottomed, when it looked, just like, it was the worst day right there. That was the worst day of the year so far, that big red candle from, what was that, Tuesday, I think. All right, well, we'll wrap it up here, and, or no, Monday, I should say. And I'll follow up. We'll see what happens today. I just want to kind of get this out there and, stay, be flexible, keep an eye on things, and I'll follow up with some other updates on things I wanted to point out, like coffee, wheat, natural gas, crude oil, and all that. I'll either get some static charts out to you guys or do a separate video on commodities. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.